Good morning, everybody, and welcome to our Asset Protection Strategies webinar. My name is Richard Kalorti. I'm the Marketing Manager at HLB Manjut in Perth. And this morning's webinar will be presented by our partners, Litsa Christodulou and Rowan Tracey. If you have any questions at all, please submit them through the Q&A box at the bottom of your screen, and we'll go through the questions toward the end. Given this is a 30-minute webinar, let's jump right in and we'll go straight to you, Rowan.
Thanks, Richard. Good morning, and thanks for tuning in to today's webinar covering asset protection strategies. My name is Rowan Tracey, and I'll be co-presenting with my fellow partner here at HLB Manjut, Litsa Christodulou. The topics we'll touch on today include risk profiling and risk mitigation, taxation versus asset protection benefits, business and investment asset structuring, the director penalty regime, some superannuation strategies, and the currently topical 100A issues. Next slide, please, Richard. Before starting, I must refer you to our standard disclaimer and remind you that all content covered today is general in nature, but please feel free to contact us after today's session to discuss your personal circumstances further if need be. Next slide, please. In my view, the starting point to any good risk asset protection strategy is risk profiling from a personal and family perspective. Now, I understand risk or perceived risk is very much a personal judgment matter and contingent on any number of factors, such as a person's risk appetite or their individual tolerance to risk. Identification of high and low risk individuals within a family group is essential in my view, and ensuring where possible personally owned assets are held by the low risk person is one simple asset protection strategy. It can be very important also to understand your children's risk profiles too, particularly where distributing to family trusts, which literally we'll touch on in more detail a bit later on. I would also advise people to be aware of transaction costs such as transfer duty, GST and capital gains tax when considering transferring assets either amongst the family or to other entities. So what are some simple risk mitigation strategies that you could implement? One of the most obvious risk mitigation strategies is insurance. I would personally not be relying on insurances alone as your sole asset protection strategy. However, it's important to ensure that you have adequate insurances in place to mitigate any business or personal risk. Personal insurances are essential, in my view, to protect your family home or other assets that you may hold personally, and also from an estate or succession planning perspective. A binding financial agreement, or commonly known as a BFA, between you and your spouse is also a good strategy that can provide certainty for the family when it comes to protecting assets and capping wealth transfer. These are more common in blended families or second marriages, but they can be an effective way to minimise the risk of certain assets being exposed to family court proceedings, for example. The hardest part of implementing a BFA is actually starting a conversation about them, because they're often viewed as a control mechanism or an indication of mistrust, which is problematic amongst relationships. Not generally thought as an asset protection strategy, so to speak, a will increases the likelihood of your personal assets being distributed as per your wishes. For complex affairs, blended family situations, or significant wealth transfer, a comprehensive and well thought out will is essential in my view. Please don't set and forget a will. These should be reviewed and updated as needed based on your circumstances and whatever stage you're at in life. It is important to understand that you cannot include certain assets held by entities or superannuation interests within a will. Strategies such as a binding death benefit nomination or reversionary pension in the superannuation fund situation, or providing your executor with a clear statement of wishes regarding the assets held by a trust or company, are typically used amongst our client base. Finally, an important risk mitigation strategy involves structuring your business or personal asset holdings in such a way that they're protected as much as possible from creditors. Asset protection always needs to be weighed up against commercial realities and business requirements. There's no point in having the most effective asset protection structuring in place if this prevents a business from operating in a particular sector or industry. And finally, there are always going to be pros and cons of different structures, and these need to be evaluated to determine the appropriate structure for your needs. Next slide, please, Richard. So now you've undertaken a personal, family and business risk profile and considered some of the risk mitigation strategies I mentioned earlier. So what about legal tax minimisation? Negative gearing, for example. One strategy is to ensure that a high income earner with a low risk profile holds all negatively geared assets in their personal name. The tax advantage with this strategy is the highest rate of tax is applicable to the negatively geared investment, obviously resulting in the greatest tax impact or benefits. Now, I understand there may be a temptation to hold negatively geared assets via the high risk, high income spouse to take advantage of their marginal rate of tax, which may not cause issues in some cases. But again, this comes down to your risk tolerance, what's a priority for you, and the assessment of any alternatives that are available. Some people may prefer, for example, to hold assets via entities. However, it's very important to understand that negative gearing generally doesn't work in trusts, for example, due to them being trapped in the entity, not being able to be distributed and subject to certain loss recoupment rules. Next slide, please, Richard. So when I'm advising clients on the appropriate business structure from a business or investment holdings perspective, I weigh up a broad number of factors, with asset protection and industry requirements being two factors I give probably the most attention to, as well as tax, of course. I'll now take you through some common business structures, their key attributes, and examples of when they may be appropriate for your circumstances. A sole trader is the simplest and most cost-effective structure. However, it's one of the riskiest when it comes to personal asset exposure. A sole trader is fully exposed to the business and operating risks. And in the event of a catastrophic business failing, all of the sole trader's personal assets are potentially at risk from creditors. 100% of the income earned by the sole trader is attributable to the sole trader themselves, and there is limited flexibility when it comes to engaging family members, for example, to assist in deriving the income. A sole trader, in my experience, is likely to be appropriate for your one-man bands, deriving income from personal services generally, with limited or no ability to split income between them and their spouse, for example. They're also popular for relatively small-scale, low-risk operations that may be generating losses initially, especially in the startup and maturity phases of business. I would generally not be recommending this business structure for individuals who work in high-risk industries, are very asset-rich, or a requirement of their business is to employ a large number of people. If this structure is essential and chosen, I would be referring to my risk mitigation strategies to try and manage any risks associated with this type of structure. A partnership business structure is typically uncommon amongst unrelated parties these days, with the exception of some legacy businesses. And this is primarily due to the joint and several liability risk and exposing all the partners to this. A partnership typically derives business income, and the net profits are distributed to each partner in accordance with their profit share, generally as dictated by the partnership agreement. We typically see partnerships these days used as an alternative to a unit trust, for example, for property ownership, or in the case of an unincorporated joint venture, where two joint venture participants are deemed to be a tax law partnership due to the joint receipt of income. Whilst I would never say never, my mind, to be honest, rarely turns to a partnership structure these days. Now, a discretionary, or more commonly known as family trust, with a bucket company or corporate beneficiary were very popular business structures in the 90s and early 2000s, due to these structures being viewed as somewhat having the best of both worlds, which is capping tax on the income of the corporate rate, while still being flexible enough to distribute to a broad number of beneficiaries, particularly from a capital gains tax perspective. The popularity of trusts as business vehicles has somewhat reduced since the ATO changed their position on this in around the 2009-10 year, which broadly forces the trust to either pay the distributions across to the companies, enter into complex arrangements, or pay tax on these distributions, ultimately via dividends from the companies to individuals. Now, a trust in its purest sense should be viewed as a conduit of income and capital and consists of three main components: the trustee, who effectively controls the trust property or assets of the trust, and the beneficiaries whom the trustee is holding the trust property on behalf of. Unfortunately, It's no secret that discretionary trusts are not viewed favourably by the ATO, and they've been under attack for some time now in one way or another. Whilst there are still a few businesses being conducted via discretionary trusts, we typically see these in investment asset holding capacity these days. The main reasons, in my view, for this is whilst it may be flexible to distribute income and capital via a trust, your options are limited when selling the assets of the business. A discretionary trust also has a perpetuity period, which means that they must vest at some point in time and cannot continue indefinitely. In Western Australia, that's generally 80 years. From an asset protection strategy, a discretionary trust can still offer good asset protection, as well as capital gains tax when structured correctly in an investment holding capacity. When assisting clients, particularly high-risk clients, with establishing a discretionary trust, we would typically advise them that the trustee should be a company if there is concern regarding asset protection or separation of assets. The low-risk spouse should be the holder of the shares in the trustee company. The high-risk spouse or the primary decision maker should be the director of the trustee company. And ideally, there should be a dual appointer or role between spouses, or failing that, the low-risk spouse should be the appointer of the trust. Also, from an asset protection perspective, consideration should be given to whether unpaid distributions owing to high-risk spouses or adult children should be reassigned or gifted to lower-risk beneficiaries. Now, I note this may be risky given the ATO's current view in some recent draft rulings, which Litsa, again, will touch on in more detail shortly. Finally, unit trusts are another business structure that we're seeing a little bit less of these days. They're more commonly used in property investment ventures with unrelated parties, or where, for example, you want to use a self-managed super fund to invest in property as an alternative to debt funding or via limited recourse borrowing arrangements. Finally, a company, in my view, is by far the best asset protection vehicle that can be used in business. The limited liability nature of a company means that shareholders, employees, and directors' personal liability to the operating risks of the business are relatively low. There are some personal risks for directors, which again, Litsa will touch on in more detail shortly. And it's also very important to understand and be very clear on any personal, director, or cross guarantees that have been entered into on behalf of the company to secure debt funding, for example. These arrangements will typically involve a charge over personal assets, as well as the assets of the company, whether that be individually or in the form of the company's shares, and potentially also capture assets of related party entities. As we probably all know, a company has a fixed rate of tax and typically distributes after-tax profits to its shareholders via dividends. Unfortunately, a company is not eligible to receive a 50% general capital gains tax discount, and whilst a popular business vehicle, it is not generally the best entity to hold investment or appreciating capital gains tax assets. A typical structure we see involving a private company is for 100% of the shares to be held by a discretionary trust, with one or more of the family members being directors of the company. Not only does a company offer maximum asset protection and fixed rates of tax, they can run in perpetuity, unlike a trust. And in terms of exit strategies, you can either sell the business assets or the shares in the company, which can offer a little bit more bargaining power when you're looking at exiting or succeeding your business. So a question that I'm sure is on a lot of people's mind is, what is the best structuring for me? Unfortunately, and in typical accountant style, that does depend on your circumstances, particularly you and your family's risk profiles, your business and personal needs, and your short-term and long-term wealth accumulation goals. It is very important to engage your advisors, whether that be accountants, solicitors, business or insurance brokers, or financial planners, to get a clear understanding of your circumstances, evaluate the alternatives, and decide on a structure of your business or financial affairs to ensure that this works for you. Unfortunately, we're not always in control of our own business structures. For example, you may have an opportunity to join a business as a partner and have no choice but to engage in one of the riskiest business structures from a personal liability risk perspective. In this case, the priority is obviously risk mitigation. Some of the questions you could ask yourself include, are there any indemnities or insurances I can avail myself of? Can I transfer some or all of my assets to my spouse or an entity? But what are the costs in doing this? Or am I prepared, for example, to forego the main residence capital gains tax exemption to protect my home by holding this in a trust, for example? A good strategy we see involves multiple entities being used by our clients, such as the business premises being held by a trust and the business operating as a company, or a discretionary or unit trust being used as a service entity, or finally a superannuation fund holding a business premises and leasing this back to the business. So ultimately, there are likely to be a number of entities at play from an asset protection and business operations perspective. In my view, the key is to ensure that investment assets are separate from business risk by holding them in separate entities or structures where possible. And finally, can you restructure your affairs? In short, the answer is generally yes, but you need to be very wary of any transaction costs, in particular transfer duty, or more commonly known as stamp duty, which is often a sleeper issue and not initially focused on when looking at restructuring your affairs. Okay, I'll now hand over to Litsa, who will cover director penalties, superannuation strategies, and 100A issues.
Thanks very much, Rowan. As Rowan said, I'm going to talk a little bit more about the asset protection strategies in relation to super. And most people know the tax advantages of investing in superannuation fund, but I'm just going to go through a couple of the important points in relation to that. So first and foremost, we all know that the earnings and any contributions that enter into a super fund sphere are actually taxed at 15%. On retirement, if a member's balance is less than 1.7 million, which is the current transfer balance cap, then any earnings in that super fund while the member is in pension mode are effectively also tax-free. From a capital gains tax perspective, the sale of an investment in a super fund is discounted at 1/3 and then taxed at 15%. This is as opposed to individuals who get a discount of 50% and then charged at their marginal tax rate. What people don't know is that investment in a super fund, it provides excellent asset protection. Generally, superannuation members' balance cannot be touched by the bankruptcy trustee. However, if a person actually does something while their business is effectively going under by putting in superannuation, then that would be considered a deliberate offence to defraud the creditors, and therefore that becomes an issue. I'll just give you an example of that. If you're contributing throughout the last 10 years at $25,000 at the concessional cap, then all of a sudden you know that your business is potentially in strife, and that you put, to try and protect your assets, you put $300,000 in super. Well, unless you have a very valid reason as to why you put that extra amount into super, that could be at risk to be clawed back under the bankruptcy trustee. Now, also on top of that, you have your pension, or if you take out a lump sum out of your super, that's gone into your personal bank account. So again, that's not protected. So once the funds exit from your super fund, bankruptcy trustee can have access to it. Another thing to note is that if you're a director of a corporate trustee or an individual trustee of a super fund and you do become bankrupt, you're effectively considered a disqualified person. If you are considered a disqualified person, then you have 6 months to resign after you're declared bankrupt. Otherwise, you could potentially be imprisoned. So once this happens to you, the trustee member rules are breached, and therefore you can no longer keep monies into self-managed super fund, and you have to transfer it into an APRA regulated fund. Once that happens clearly, then you can't generally choose what investments you invest in, so that becomes a bit of a disadvantage. Rowan also talked about the ability to have business real property within the superannuation fund. And as long as the rent is done on an arm's length basis, then the investment rules are satisfied. But what you've got to remember is that any asset that's put into a super fund and its earnings are effectively locked in until there's a condition of release. Also, there are very strict rules about what can and can't be invested in a super fund. So generally, if it's something outside the box, we recommend that you seek advice. Otherwise, potentially, you could breach the rules. Next slide, please, Richard. Now, Rowan alluded to the benefits of having a company structure and the limited liabilities around that company structure. But of course, the directors' penalty regime has actually been, which was introduced a couple of years ago, now exposes directors to things like pay-as-you-go withholding, super guarantee, and any estimates that have been given to the company by the Commissioner in relation to both of those. Now, the directors have an obligation that begins, for example, with a company when it withholds the pay-as-you-go withholding from the salaries, or for superannuation guarantee, it's on the last day of the quarter. And if it's an estimate that's been given to the company, it's actually becomes due and payable. It becomes an obligation when it's due and payable. The obligation remains until the company complies with that obligation, so it pays it, or it appoints a liquidator or administrator. There is some defences around this particular area, and one of them is where the director is ill or for some other good reason hasn't taken part in the management of the company, so they're unaware that the obligation hasn't been paid. And in the case of SGC, the company took a position that's a reasonable, arguable position. Now, as with all these things, the onus of proof is on the director. So if you haven't got proof around this, you'll still be personally liable. Next slide, please, Richard. The other added tax that has been added in February 2020 under the director penalty regime is also unpaid GST. Now, this amount is not only the GST collected and paid, but it's also wine equalisation tax, luxury car tax, and any instalments, GST instalments. So what's been happening around to try and avoid this is that directors are basically backdating their resignations prior to the obligation existing for these particular taxes. So this loophole was changed, the legislation was changed, and now on the 18th of the 2nd, 2021, directors can't backdate their resignation to avoid these director penalties. So what does that mean? A person's resignation of director is as and when ASIC is notified. Now, ASIC must be notified within 28 days of the director's resignation. So just as an example, if a director decides to provide a letter to the company that they have resigned on the 1st of May 2021, but within that written resignation letter, the effective date of resignation is the 1st of the 4th, 2021, then this would clearly not meet the 28-day period that ASIC has to be notified. Again, I think it's important to realise that a director cannot resign without having any other directors of the company, because the company needs to have at least one director. There's one exception to this, and that is to do with when a director resigns on or after the wind-up of a company. So you might ask, what does this mean from an asset protection point of view? Look, the company is still a great vehicle in terms of asset protection, and it's obviously got plenty of benefits from a tax point of view. But this just highlights the importance of making sure that each director actually knows what's going on in the company in terms of the day-to-day cash flow requirements. A lot of mum and dad companies, the dad operates in the business and the mum is simply a signatory on minutes, etc. If the spouse has their house in their own name, that could be exposed in this case. So it's really just a matter of making sure that if you have even a little bit of a sniff that you can't pay, the company can't meet its ATO obligations, you should seek legal advice and accounting advice. Next slide, please, Richard. Now, I'm just going to be talking a little bit about section 100A and the importance of this new ruling and practice law guideline that was issued on the 23rd of the 2nd, 2022. So it's fairly new, and it has some impacts in relation to asset protection, and definitely has impacts on the tax benefits associated with trusts. Now, I'm not going to get into the technical jargon of this section. It's a section that's been around for 40 years and effectively has been a sleeper section. The ATO is saying that this section now can apply where a beneficiary of a trust has received a distribution but doesn't actually receive the benefit in relation to the distribution. So they don't receive the income, the cash effectively. In this instance, the distribution is considered to be invalid for tax purposes, and in turn means that the trustee is liable to pay tax at the top marginal rate. Not great. There is an exclusion, and that's where there's an agreement that's been entered into that's considered ordinary, family and commercial dealings. Now, there's no definition about ordinary and commercial dealings within the Act. So all that definition is based purely on case law at the moment. Look, for a long time, many professionals have trusts, and they've been great from an asset protection point of view, as well as distributing to beneficiaries that are on lower marginal tax rates. And I think Rowan alluded to this previously. It's been common practice for any entitlement that's arisen for the income from the distribution, especially to an adult child, is gifted back to their parents. And this was basically done, especially where the adult child is either getting married or is in a de facto relationship or becomes a professional person that may be sued at a later stage in life. The gifting of the distribution was done on the basis that the parents have incurred costs prior to the adult child turning 18. So such costs as school fees, clothing and living expenses. The ATO has come about and said, well, this is a no-go zone. We won't accept this. In their view, the costs of schooling, living and clothing for the child that is under the age of 18 is a basic parental expense. Therefore, the only reason that you distributed income to this adult child now is to gain a more favourable tax outcome. There is some good news at the end of the tunnel though. A trust distribution that's distributed to a low-risk spouse that's going into where the income's going into a joint bank account and is used for the benefit of the whole family, including dependent children, won't attract the attention of the ATO. So again, there's still some benefits from an asset protection point of view, but this ruling and the practice law guideline, which are both in draft, by the way, now limit some aspects of asset protection. And the reason I say this is because undrawn beneficiaries now either have to be left in the trust for investment purposes, which is allowed, or working capital requirements, or they have to be paid out to the spouse or the adult child. And in that particular instance, in both those instances, they become either part of your family law asset pool or part of the estate from a bankruptcy point of view. This is not great news if you're trying to protect the family wealth, which has grown over generations from outsiders. I think it's important to note that the ruling and the practice law guideline is an application of this particular section retrospectively back to 2014. Now, this has caused much angst with both many tax practitioners, including myself, and their clients. There's heavy lobbying going on by all the professional bodies at the moment to change this aspect of the draft ruling and the practice law guideline. And basically, the submissions for that are going to be at the end of this week. So hopefully the ATO sees some logic in relation to this. So unfortunately, it's just going to be a wait and see to see what happens with the final ruling and the final practice law guideline. Now, Richard, that's it from me. I just want to know if there's any questions.
All righty. Thank you, Rowan and Litsa, for those informative presentations. No questions have come through as yet. I'll just give viewers a couple of seconds if they do have a question to type through. If not, we will wrap up today's webinar. Nope, that doesn't look like there's any questions. Thank you, Rowan and Litsa, once again, and thank you everyone for joining us this morning. If you have any follow-up queries, you can email us at hlb@hlbwa.com.au. Oh,
Richard, yeah, I can see.
Yes, here's one. when does retirement phase commence for super?
When you either satisfy a condition of release in terms of retirement, or it can happen before that. Oh, sorry, Bernard. Yes, it can happen. It can happen before that if you're transitioning to retirement. But I may make a suggestion that any of those questions need to be answered by a licensed financial advisor, and I'm not that person.
Litsa, the viewer has just come back to say they meant pension phase. When does pension phase commence for super? Is that the same thing?
Yeah, look,
when you basically start a pension. So you've got to be over the age of preservation age, and over the age of 60 is you've satisfied a condition of release, my understanding. But again, I'm not an expert in that area.
Great. Okie doke. No more questions. Once again, thank you all for joining us, and we hope to see you very soon. Thank you very much.
Thank you.